Hey everyone, and welcome back. Today, we're diving into one of the most powerful concepts for understanding institutional footprints on the chart: order blocks and breaker blocks. If you've ever wanted to see where the smart money is placing their big orders, this is for you. So, here's our game plan for today. We're going to cover what order blocks are and how to spot them. Then, we'll break down breaker blocks. We'll look at the key differences and use cases for both. And finally, we'll see how they integrate into the broader ICT market structure framework. Stick with me, and by the end of this, you'll have a much clearer picture of how to use these zones in your trading. Let's start with the basics. What exactly is an order block? In simple terms, order blocks are areas on the chart where institutional traders have placed a large concentration of their orders. Think of them as the footprint of smart money. You can identify them as the last candle, or a small cluster of candles, right before a market makes a strong, impulsive move. That candle is like the starting block for a sprinter. It's where the big players position themselves before the race began. You'll sometimes hear terms like Type 1 and Type 2 order blocks, or see them in relation to fair value gaps. We'll touch on that as we go. You might be asking, why should I care? Here's why. They reveal where smart money is either accumulating, buying, or distributing, selling. Because of this, these zones often become fantastic areas of potential support or resistance. And for us as traders, they provide incredibly precise entry areas for when price returns, allowing us to join a continuation move. Now, not all order blocks are the same. There are two main types. A bullish order block is typically the last bearish candle right before a strong upward move. The selling pressure was absorbed by large buyers, leading to a rally. Conversely, a bearish order block is the last bullish candle before a sharp drop. That's where buying enthusiasm was met with overwhelming selling from institutions. Okay, this is crucial. You can't just mark every candle before a move. You need to confirm it. Here's a simple checklist. Look for displacement, that strong, momentum-filled move that happens after the block. Confirm there's been a market structure shift, MSS, a clear break of a previous high or low. Ensure an imbalance or fair value gap follows the move, showing inefficiency. And most importantly, be patient. Wait for a retest of the order block for your entry. Don't chase the move. Now, let's talk about what happens when an order block fails. This is where we get a breaker block. A breaker block is essentially a former order block that didn't hold price direction. The level was broken with force, and its role has flipped. It's now a zone that can signal a reversal of the previous trend. The formation is a three-step process. An order block fails to act as support or resistance. Price smashes through the zone with conviction. That old order block now becomes a breaker block. If it was a bullish OB that broke down, it becomes a bearish breaker, and vice versa. So, let's quickly compare the two. Order blocks show you where smart money originally entered a trend. They are about continuation. Breaker blocks show you where the market structure reversed. They are about rejection. But both are incredibly valuable for identifying high-probability trading zones. To truly get this, you need to think like they do. Smart money uses these zones to execute their massive orders efficiently without moving the price against them, manipulate price to run retail stop losses and create liquidity. And often, they will revisit these zones to fill any remaining parts of their large orders. Now, let's talk about the common pitfalls. Don't be the trader who identifies blocks without any confirmation from market structure, tries to trade every single block they see, without considering the broader context, ignores the need for displacement and proper timing, like trading around major economic news. These blocks aren't meant to be used in isolation. Their real power comes when you integrate them with the wider ICT framework. Combine them with concepts like liquidity pools and market structure shifts. Confirm their validity with the time of day you're trading in. And always use mitigation, waiting for price to come back to the zone, for your optimal, low-risk entries. So, if you remember nothing else, remember these three things. Order blocks reveal institutional intent and are your map for continuation. Breaker blocks reveal when that intent has changed, signaling a potential reversal. Understanding both will dramatically improve the precision and confidence of your trading. In conclusion, mastering order blocks and breaker blocks is about learning to align your trades with the institutional flow. It transforms the market from a confusing mess of candles into a clear story of supply, demand, and manipulation. It takes practice, but this knowledge is a game changer. Thanks for watching, and I'll see you in the next one.